This is Kim Sterling, certified financial planner and founder of Next Gen Wealth Partners. And as part of a financial education series, today I'm going to be talking about what a stock is, a mutual fund, an index fund, and bonds, things like that. And I want to point out that after watching this video, this will not make you an investing ninja. This is literally the ABCs of investing, and it's always better to consult a financial professional. And with that, we're going to go ahead and get started. So, when we're talking about investing, the whole point is to make our money grow. And there's a couple of different ways we can do that. One is by purchasing equities, also known as stocks. And we can also invest in fixed income instruments. And I want to provide a visual here on very simply on the topic of asset allocation and fixed income instruments being your foundation. And I can do another video on that, but I just wanted to sort of give you a visual of how we layer different investments within your overall portfolio to achieve asset allocation. Okay, so what is a stock? What is this? Well, when you buy a stock, you're actually buying ownership in a company or a lot of different companies, and as a result, you celebrate in the wins and the losses of that particular company or companies. You see, this is how the stock market blips on any given day. And there are different ways that a stock can make your money grow. The first way is through what we call capital appreciation, otherwise known as growth stocks. These tend to be your small to mid-sized companies that are focused on, you guessed it, growth. And the other way that stocks can provide growth for us or additional money on top of our money is through dividends. And these are typically your larger companies. Not always, sometimes a smaller mid-sized company will pay dividends, but by far and large, it's usually these larger, more stable companies, also known as blue chip stocks. You may have heard that term before. These are all synonymous with one another. So if you think about it, let's say that you bought a growth stock at X price and then you sold it at a higher X price. Well, that is growth. That's capital appreciation. That's money in your money bucket. For the dividend paying stocks, these are known as your growth and income stocks. Growth because they still have some capital appreciation potentially associated with them, but they also pay a dividend. And that's just the company rewarding you as an investor with a little extra. They may say, well, for every one share of this stock you have, you get a $2 dividend. So again, that's money into your money bucket. Typically on a risk scale, when we look at risk, your larger companies are typically lower on the risk scale. So this is higher risk, and your small companies are typically viewed as being higher risk just because they're kind of new to the scene. We don't really know how they're going to perform over time, but you're also typically rewarded for taking on that risk with the growth. Okay, so higher risk, potential higher growth. And again, this is how we start to layer your portfolio with these different companies and such. All right, now let's talk about how a fixed income instrument works. When you purchase a fixed income instrument, you are actually loaning money. And so, an example of this is, let's say that you bought a bond for a school that was being built in a municipality. And this municipality, they don't want to sell shares of the school, right? They don't want to give you ownership, but they still need to raise some capital. And by the way, this is the same thing that these companies are doing, right? They want to raise some capital so that they can achieve their goals. On this side, you're actually an owner of that company share wise. Over here on this side, you are a loaner. All right, so let's say you purchased a bond for a school that was being built, and the deal is you put money in to this instrument, this bond, and you're going to be paid a stated interest rate on this instrument. So let's say you had this bond for 5 years. You put the money in, and at the end of the 5 years, you get your money back plus the interest. Sometimes they'll pay, most of the time, they'll pay you interest along the way, quarterly, annually, whatever the case may be. But again, this is additional money going into your money bucket in the form of interest, what we call interest income. Now, there are risks involved on both sides. Okay, so it's important to know what those risks are. You can speak with your financial professional about that. So, all right, I hope you've taken notes, because now we're moving on to what a mutual fund and an index fund is. But I just wanted to give you sort of this foundation for how these instruments work. All right, so let me come over here, grab my eraser. These are, by the way, if you bought individual stocks, individual bonds, individual CDs or treasuries, which also fall into this fixed income category. Okay, so I'm going to leave some of this up, but let's talk about mutual funds, and index funds. And one of the hallmarks of investing is diversification. And the reason why we do that is because we never really know how a particular company is going to fare over time. And it's the proverbial not putting all of your eggs into one basket. Well, in order to really reach diversification, if you were buying individual stocks, you would have to buy a lot to get this diversification. Same thing with fixed income instruments. So one answer to that is mutual funds, which you can think of, and index funds, right? These guys are kind of similar. We're going to talk about the similarities and the differences. So mutual funds, you can think of as a bucket of companies. And when you put your money in here and investing, you are investing in a little slice of all of these companies. Okay, same thing with index funds. It's a basket. It's a pool of investments and a pool of money going in, buying a slice of all of those investments. And so that way you start to get diversification. Because as far as I know, no mutual fund has ever failed or collapsed, right? Now, let's talk about some of the differences here. With a mutual fund, this is what we call active management, because there are fund managers, usually 2 or 3 of them, that are watching this fund to make sure that it meets its objective. Now, here's a little quiz for you. Remember, we were talking about growth and income, right? Or even just straight income. So those are objectives, right? And it's based on that risk scale that we talked about. So these fund managers, they want to make sure it's meeting the objective. Well, if it's not, if some of these companies are no longer meeting the objective of the fund, they're tossed out and they're replaced with something else, or maybe their holdings are reduced somehow. But the point is, they are actively rotating things in and out of here. Now, because of that, they pass down capital gains to the investors. So sometimes these aren't as tax advantaged as index funds because of this active management. It doesn't matter that you, the investor, the purchaser of this mutual fund, didn't rotate anything out. They did. There was some buying and selling going on in here, so there might be some taxes, okay? Also, these have a tendency to be a little bit more expensive because these fund managers need to be paid, right? They're actively managing this fund for you. Now, on the other side, index funds, also known as ETFs, sometimes just stands for exchange traded funds. They trade throughout the day on the stock market, whereas mutual funds trade end of day. But be that as it may, these are passive, meaning they're not, well, I mean, sometimes they can be actively managed or sometimes as a hybrid, but in general, this is what we refer to as passive management. They track an index, right? So if you were to purchase a particular index, that is what it would track, right? So whatever the index is doing on any given day, that's what it's following. Okay, so you still have the diversification because it's a basket of funds or investments, but it's passive management, so it tends to be less expensive. And because things aren't being rotated in and out of here, like a fund manager does over here on the active side, it tends to be a little bit more tax efficient. Okay. So when it comes to knowing which one to pick and how much to put into a portfolio, that's when, again, this is very much the ABCs. When you remember you were in kindergarten and you were learning how to trace on a piece of paper, you were learning how to do lowercase letters and capital letters, and then over time you learned how to form sentences, right? At first your sentences were 3 words, right? And then your sentences became much longer. Then you started to write paragraphs, and then you started to write a book, or a term paper, or what have you. Investing is very much the same way. So I really want to make the point that just because you have seen this, this is literally the ABCs of this. It goes much, much, much deeper. But the reason I do these videos is because, number one, I want people to start feeling a little bit more confident, start to understand the lingo. That didn't turn out too great. The lingo, so that you kind of understand what's going on. But I am very much a proponent of sitting down with a financial professional, collaborating on your plan, so that you know each step of the way that it's the right step for you. All right. Well, of course, if you have any questions, feel free to reach out anytime.